Live from New York City, let's get you to the weekend. For our audience worldwide, good morning, good morning. Your equity market just a little softer, negative 0.25%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, the latest data likely locking in one more rate hike. First Republic looking for a solution going into the weekend, and Speaker McCarthy attempting to turn up the debt ceiling key. We begin with the big issue, looking ahead to the Fed.
The Fed's not done.
The Fed's job is not done.
100% May will see another hike.
You've got inflation that's still sticky.
That is what the Fed is looking at.
I think they'll do one more. I think it's entirely unnecessary.
They have said that they're very data dependent.
The data that the Fed is looking at is mostly coincident and lagging.
The things it's going to gravitate to are the low level of unemployment in the U.S.
Those leading indicators that continue to weaken.
They are going to have to start to talk those forward expectations up.
Almost no one is talking about beyond May.
The market has been all over the place.
To have the Fed cutting interest rates, to have inflation be well under control, and then to also have earnings basically come in at 220 and the economy continue to grow. I mean, it's just not going to happen.
The market is pricing cuts more likely than not starting in Q3.
I mean, it's the most wishful thinking that we've ever heard of.
Joining us now to discuss that wishful thinking, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, always a privilege, a pleasure to catch up with you to close out the week. Looking ahead to next week, I read your piece in the Financial Times a little bit earlier on this morning. Allow me to share that with our audience, just the title of it. Policymakers and business need to adapt better to structural uncertainty. The global economy is facing an unusual spread of plausible outcomes. Mohammed, reflect on that for us, build it out. How important is that going into next week's decision?
So I don't think it's important for next week's decision, but it's really important for what happens next. I would be shocked if the Fed didn't hike interest rates by 25 basis points. The inflation data we got, and we got quite a bit of it today and yesterday, suggests that it's hotter than what where the Fed would like it. And wages at 5.1% is going to worry the Fed. So we will get 25 basis points. It's what happens next. And it gets really complicated because the Fed has this trilemma. How do you bring down inflation, maintain economic activity, or at least minimize damage to economic activity, and maintain financial stability? And you're getting really conflicting data because the underlying uncertainty is now structural. It's not just cyclical, it's structural, Jonathan.
Well, that makes it even more difficult then. Mohammed, one feature of our conversations over the last several months has been a Federal Reserve that you've suggested is too data dependent. Highly data dependent. Is that what you're getting at here as well?
Yeah, they have three problems. One is there's no strategic underpinning. And you can't be overly data dependent because, as you played at the beginning of the show, data is lagging and your policy tools operate with lags going forward. So you're looking at the wrong thing. So if you're excessively looking at the wrong thing, you will have an accident. That's issue one. They lack a strategic view. Issue two, they've got the wrong monetary framework. So it's as if they are trying to control inflation on the ground, but they're not controlling the skies because the framework they have is for a world of deficient aggregate demand, not a world of deficient aggregate supply, which is the world we live in. And third, they don't learn from their mistakes. So that is why it's become so complicated. That's why the narrative has changed I don't know how many times. That's why the 2-year has been all over the place and it hasn't been anchored. So that's a fundamental element of policy adding to the uncertainty as opposed to reducing it, Jonathan.
How would you suggest they develop a better strategic view when you acknowledge some of the structural issues are becoming increasingly uncertain?
So I think this is my viewpoint. There are things that you can bet on. You can bet on supply will be less elastic going forward. And we talk about these issues all the time. Companies are rewiring their supply chains for resilience. Geopolitics is having a bigger influence on economics. We see that every single day. The labor market remains tight, and we have major transitions coming forward, including the energy transitions. All that suggests that supply will be less elastic. That has to be reflected in how you think about this economy. Secondly, you've got to make a decision. Do you believe in the separation principle or not? Do you believe that monetary policy should be directed at inflation and other tools should deal with financial stability, the ECB view expressed over and over again? Or are you willing to commingle the two? They've got to be really clear on that, John.
If they took that approach, your approach that you're outlining, what would be different about what they're doing right now and what they're projecting through the year ahead?
So what certainly would have been different is they would have started earlier. They wouldn't have had to concentrate the rate hikes, and they wouldn't have had to put financial stability in play as it is now. But that's water under the bridge. It's unfortunate because it's taken away the first best option. If they had put that in, the market wouldn't be so disconnected from the forward guidance. The market wouldn't be pricing in the sorts of cuts that we're pricing in and the sorts of end-year rate that we're pricing in.
Equities right now down about 0.2%. The opening about 25 minutes away. Mohammed, we need to talk about some of the economic data as well. Mike McKee's been looking at that for us. Mike, sum it all up, not just this morning, but the week, the month so far going into next week.
Well, I think Mohammed already did in saying that what we have seen is not going to influence the Fed for this meeting. It's maybe the next meetings that they're going to start thinking about. When you look at the income and spending numbers, we've seen the same pattern as we had seen in the prior 2 months. Strong January, weaker February, and then in March, spending comes in completely flat. Income's up 0.3, same amount, and you can see the savings rate did go up. So people still have some cash, but they seem to have pulled back on spending it. Is it because of inflation? Well, headline went down, especially on a year-over-year basis, base effects in that, but the core not moving all that much. However, the, shall we call it the Jay Powell indicator, the PCE core X housing did decline again. So we see on a both month-over-month and year-over-year basis that slowing somewhat, which would be good news for the Fed if that continues. The employment cost index, which they like to look at because it's more granular, but it is only quarterly, comes out for the first quarter, and it's pretty consistent. Compensation, wages, and salaries and benefits all up 1.2%, a little bit more than they were in the fourth quarter, but not a huge jump. And one bit of good news that I know Mohammed will be interested in, the Aaron Rodgers signing to the New York Jets is going to convert his $58.3 million bonus this year into, salary this year, into a bonus. So it will not affect the wages and salaries component of the second quarter, the ECI.
And Mike McKee, you know I've got to go to Mohammed on that now. And Mohammed, I know you probably didn't want to talk about this because I know your view on it. Can you give us your word, your take on how pleased you are with your new quarterback?
So first, I'm very pleased with what Mike McKee just said. Thank you, Mike. That's important. And it's part of the sort of general issue. I understand this notion of go outside and try to get one Super Bowl done. I worry about the longer term. So I just hope that this trade of bringing a very good quarterback, but late in his career, to the Jets doesn't translate into not focusing on what we really need to build going forward.
Are you suggesting the Jets need a better strategic underpinning in the same way the Federal Reserve does, Mohammed?
You could very well say so. I can't possibly comment, John.
Let's talk about the economy and keep you out of trouble. I want to talk about some of the calls that are coming from the south side at the moment. It just says slow down, slow down, slow down. Across the board here seems to be the consensus view of things. BNP Paribas had this to say: we continue to anticipate a recession in the second half of 23. Morgan Stanley expect to see significant slowing. Bank of America expect the momentum in the economy to continue to slow in 2Q. Mohammed, they're talking about the cumulative tightening of the last 12 months. They're talking about the tightening of financial conditions off the back of the banking difficulties of the last 6 weeks or so. You on the same page as that, Mohammed? Are we losing momentum in this economy?
Yeah, I mean, most of the street has been projecting a recession that's just been pushing it forward, pushing it back further and further. And I've said consistently, it's not a done deal. We can still avoid a recession. Yes, we will slow. Undoubtedly, we will slow. And we've already slowed, although the quarter one slowing had a lot to do with inventories. So I wouldn't extrapolate it. If you look at consumption, that remained incredibly robust. The labor market stays robust. We will slow. I still think, John, absent a policy or market accident, we can avoid a recession.
Well, let's talk about consumption. Pepsi, Coke, Kimberly-Clark, Procter & Gamble, double-digit price increases. Mohammed, one way that you differentiated yourself from the rest of Wall Street and The Economist, the consensus view back in the summer of 2021 on the inflation question. They said transitory, you pushed back. The point you made at the time was listen to corporations. Can you learn more still now from corporations reporting so far this quarter, reflecting on the last 3 months and looking forward, than you can from the hard data?
Yes, John, it's important to do so. And earnings have, on the whole, surprised to the upside. And there's a reason for that, which is a certain element of demand remains very strong. And that's what you should look at. It tends to be concentrated in the service sector. It tends to be concentrated among companies that have a combination of pricing power, brand, and market share. So it's difficult to extrapolate to the general economy a absolute recession based on the earnings. In fact, what the earnings tell you is that it's possible, but it's not a done deal. And I think people should continue to focus on earnings because companies are giving us a lot of information as to what's ahead.
Well, next week,
including on inflation, by the way.
Well, the Federal Reserve is going to give an assessment on inflation as well. And I just wonder how different theirs might be to what we're hearing from some of these consumer companies. Are you suggesting that what we learn from the consumer companies is a decent indication that inflation is going to be stickier than we're still expecting it to be?
Absolutely, especially what we learn from the service companies, the airlines. The service sector is where we should be focusing, and within that, wage growth. 5.1% wage growth is a significant number, and I suspect that wage growth number is not going to come down anytime soon. That is the problem when inflation is allowed to migrate from a few goods to the service sector. It becomes more sticky, and it becomes less sensitive to interest rates.
Mohammed, next week, as you know, there's going to be a news conference with Chairman Powell. They'll talk about cumulative tightening, and we'll have a conversation about long and variable lags. Just how long are these long and variable lags, Mohammed, after the year we've had and the speed at which they've tightened policy?
We don't know because a lot depends on what's happened to the banking system. We're going to have a very interesting report today. I wish they didn't issue it on a Friday. I wish they had issued it earlier in the week, including next week. But we're going to have a very interesting report on what happened in Silicon Valley Bank. We're going to have to resolve First Republic, and it's not easy, John. The public sector wants a mainly private sector solution. The private sector wants the public sector's involvement. It is not easy to reconcile these two things, but yet it's really important. So a lot depends on how you feel about the financial sector, and in particular, whether we're going to see a significant reduction in credit extension.
Couldn't agree more. Mohammed, wonderful to catch up with you, sir. Thank you for being with us. Mohammed Al-Erin on the Federal Reserve and his beloved New York Jets as well. The equity market negative 0.25% on the S&P 500. Let's get you some movers. Here's Abby.
Well, John, we do have lots of turnaround stocks, at least turnarounds from the post-market yesterday. Starting out with Amazon, these shares were surging yesterday at more than 10% on what appeared to be a blowout quarter, and it really was, but it's the potential for a little bit of a cloud slowdown that has the stock now down 1.8%. Snap had been down sharply yesterday. It is still plunging down about 18%. They posted their first quarterly decline in revenue, a little bit below $1 billion in revenue. That was a miss. One analyst saying this is a growth company without growth. Intel, this is another reversal. These shares had been lower yesterday, but now up 6.1%. Their first quarter data center and AI revenues beat. Analysts saying this is the potential bottom. And then finally, ExxonMobil, record profits on rising output. They blew out estimates. Those shares up 0.7%.
Abby, thank you for that. Coming up on this program, investors gearing up for Chair Jay Powell.
Given the fact that inflation is slowing but still elevated, the Fed probably hikes once more next week.
That conversation up next with PGIM's Lindsay Rosner and Neuberger's Ashok Bhatia.
I would be shocked if the Fed didn't hike interest rates by 25 basis points. The inflation data we got, and we got quite a bit of it today and yesterday, suggests that it's hotter than where the Fed would like it. And wages at 5.1% is going to worry the Fed. So we will get 25 basis points. It's what happens next
Mohammed, just brilliant moments ago. The Federal Reserve preparing to deliver its latest rate decision, the final dose of data reinforcing expectations for a May hike. On the street, the growth debate taking shape. For the consensus, the message is clear. The economy is losing steam. Bank of America expecting momentum to slow in Q2. Morgan Stanley seeing cause for a significant slowdown. BNP Paribas calling for recession in the second half of this year. On the other side, Citi's Andrew Hollenhorst looking for Fed officials to revise up growth and core inflation forecasts in June. That's the split going into next week and beyond. Joining us now to discuss is PGIM's Lindsay Rosner, Ashok Bhatia of Neuberger Berman. Lindsay, let's start with you first. Last time we caught up, you said you would like them to pause. Are you expecting them to communicate that next week?
Well, I think they're going to communicate that they're going 25 basis points. But then the real question after that is, what else do they communicate? And I think they're going to have to find some language that fits the market about how they can keep watching inflation, how they can keep watching growth, but how they can be much more metered, that they've done a lot of work and that they are not, moving away and forgetting about their job, but they're giving it some time to see how it plays out. And I think that's smart given what we're going to go through with the debt ceiling.
Ashok, going through the debt ceiling, going through the data, going through this year, there is a bit of a divide. Don't want to make too much of it, but a bit of a divide between what people expect. Some people see rate cuts. The Federal Reserve says we'll stay on hold. Ashok, one thing that you've said repeatedly and still say is they'll be slower to ease than many expect. What's given you that clarity on that call, Ashok, that is maybe missing somewhere else?
I think there's two elements to it. First, very much, inflation is going to fall in the U.S. this year. It'll fall in, Europe as well. But our estimate is that the inflation will still be above, by the end of this year, the Fed's comfort zone. So the Fed will struggle with, CPI, even if it's at 3.5%, to start on a big easing campaign, given where inflation's likely to be. And then second, we're in the camp that we'll see slower growth, but we're not in the camp that the growth outlook is going to deteriorate so much that the Fed will feel pressure from the growth side to start a significant easing campaign either.
Well, they've been on a massive tightening campaign over the last 12 months, Lindsay. How long would you expect it now for it to show up in the labour market in a material way? Unemployment's still at 3.5%. Claims have moved a little bit higher, have come back in, still in and around 200,000. It looks like a robust labour market. Then you look to the headlines from corporations and you see 10% gone here, 10% gone there, 20,000 here, there and everywhere. Lindsay, what are you focused on in the labour market? When does it start to bubble to the surface in a more material way?
Sure. So we think we can see signs of that maybe in the second half of this year. But you're absolutely right, Jonathan. The labor market is robust. And while there are maybe some idiosyncratic situations of cuts, there were certainly some headlines this morning at certain places. What we heard, I think, resoundingly through the earnings that we've received is that recession watch is going to have to happen next quarter. The guides so far from companies that we've heard are actually not terrible. They're not painting a scary picture. In fact, they're actually painting what seems to be a continued okay economy. And I think that's really the challenge that the Fed is going to have to face. How do you handle an economy that's not backing down and in one in which where we do have inflation and it's quite sticky?
Well, the market calls just as hard. Make the call on the economy. Let's say we're at 3.5 right now, Ashok, on unemployment. And you can say, OK, from here to year end, I'm expecting that to climb. Go from 3.5 to 4.5 in line with their expectations, maybe go further north than that. Do you want to be long credit with unemployment going from 3.5 to 4.5? Do you want to be long treasuries with unemployment going from 3.5 to 4.5, even with and given the move we've already had in the treasury market? Ashok, where do you want to be as that's developing in the economy?
Well, I'll make three quick points. I think first on rates, we're not going to go anywhere. We're just going to continue to chop around a 3.5% type of 10-year note. And that's really because the market is torn between, a valuation issue, which is the bond market's already priced for the funds rate to drop a couple hundred basis points over the coming 18 months. So that's already priced in. But at the same time, you've got a weaker economy and lower inflation developing, which should support bonds. So those two probably just net off and we go nowhere in rates. For credit, in that type of rate environment and a continued positive growth rate, still somewhat elevated inflation with higher nominal GDP, that's still a pretty decent setup for credit markets, even from these levels for a bit of period of time. And the third is on what are we focused on? We're really focusing on some of the I'd say, higher quality investments. There's a lot of really interesting things brewing in the mortgage market. And we've been devoting a little bit more capital to that area in particular.
Let me pick on the first 2 points. Treasuries go nowhere. There's opportunities in credit. Lindsay, do you agree with that?
Yeah, I think it's complicated right now in treasuries. The debt ceiling is a real issue. I know it feels a lot like deja vu. Haven't we been here before? And in fact, we have. Since 1960, we've raised the debt ceiling 78 times. But the world looks really different now versus when we had a really big standoff in 2011. I think that's important to keep in mind. And with that backdrop, that makes us kind of cautious on just this overall spread risk, thinking that spreads are going to tighten and you want to have that beta. We're positioned cautiously, but what's great about the opportunity in fixed income right now is you can be positioned cautiously, but still have a ton of yield. And we've talked about this before with the opportunity for security selection. There is a ton of dispersion out there, and that's the perfect market to be able to do that kind of work. I agree on the agency mortgage-backed security front. That's something that looks really interesting to us right now. I think there's so much hysteria about FDIC selling this book of mortgages, what that's going to be, the pressure, the overhang on the market. But I think we have to take a step back and contextualize, right? The size that's being sold, which is the Silicon Valley Bank book and the Signature book, is actually really small if you compare it in duration equivalent terms to what we get in the auctions from the Treasury every month. And in fact, as we're learning more about how this sale is going to happen, there's actually an opportunity out there to take advantage of the mortgages that may be attractive on this book. And also, I think when we're learning more about the mechanism, we're finding out that it's actually going to be probably a shorter timeline and less impactful than the market's worried about. So really, there's a lot of concern out there, but there's a ton of opportunity if you can really figure out the facts.
Hey, Lindsay, wonderful to get your view alongside Ashok. To the two of you, thanks for being with us. Coming up on this programme, the morning calls and later. More than halfway through earnings season, we'll break down the latest numbers with MoffettNathanson's Michael Morton. That conversation coming up shortly. Equity markets a tiny bit softer. Let's get you some morning calls going into the open. Jefferies upgrading Masco to buy, expecting shares to outperform as housing sentiment improves. Next up, Benchmark upgrading Intel to buy, saying the worst could be over with Q1 likely marking a bottom. And finally, UBS raising its Amazon price target to 130, expecting a more favourable setup in the second half. That stock is down 1.75%. Coming up, Amazon guidance throwing cold water on the tech rally. That conversation with MoffettNathanson's Michael Morton. That conversation up next. Where did April go? The first quarter felt like a decade, and then April went just like that. Equity futures right now, negative 0.2% on the S&P. On the Nasdaq, negative 0.1%, there and thereabouts. Amazon was flying after the close yesterday and then rolled over as we got some soft guidance. We'll talk about that name in just a moment. There's your opening bell. Switch at the board and get to the bond market. Going into the Federal Reserve next week, yield to lower by 8 basis points on a 10-year, 344. Looking to Europe, growth softer than expected, inflation lower than expected in Germany. The euro, a break of 110 a little bit earlier, just about holding on to that level right now. Earlier in the week came really close to 111. That currency pair negative 0.2%. I'll talk about the oil majors in just a moment. Chevron, Exxon, we'll get to that. $75 a barrel there and thereabouts on WTI, just about unchanged on crude at the moment. About 30 seconds into this session, here's the broader market for you on the S&P 500, negative 0.15%. Similar move on the Nasdaq. One stock to watch that is anything but unchanged over the last 12 hours or so. Amazon. The company's guidance pointing to slower growth. Shares taking a hit on the news. The CFO saying this: customers continue to evaluate ways to optimize their cloud spending in response to these tough economic conditions. We're seeing these optimizations continue into Q2. Ed Ludlow joins us right now. Ed, that is a lot of corporate talk. Can you make it simple for us?
Yeah, simply put, sequentially from the first quarters of the current period, Amazon quantified that the top-line growth for AWS would slow by 500 basis points. That's not the direction of travel that investors wanted to hear, because remember, in many quarters over recent years, AWS has accounted for almost all of Amazon's broader operating income. There was real hope from the street that AWS would hold up in this tougher environment because it is the market leader when it comes to the hyperscalers. But go back and look at Microsoft and Alphabet and Google, what they said about their cloud business. Remember, Google notched its first profit on the cloud unit ever. So it was an interesting moment. The roller coaster ride was we were up like 12% in after hours, and after those comments, we're lower. We're now lower a percentage point. So I guess it could be worse. Broadly speaking, macro trends are improving, right? Think about the e-commerce business. Inflation is easing off, according to Amazon executives, and consumer strength in emerging markets and international markets looks good. The question really is the depth of the cost management. And what we saw was headcount fall 10%, Jonathan, which would indicate cuts deeper than the 27,000 corporate jobs that Amazon had announced. But remember, seasonality coming off the holiday quarter. Elsewhere in the technology sector, I'm paying really close attention to Intel. The market is buying the commentary around green shoots that Pat Gelsinger is talking about for the second half of this year. It's normal for the chip sector to have a good second half, but it looks like Intel has troughed, basically. The street saying, look, this is a really difficult time for Intel, but they've hit their trough. It can only get better from here. They're forecasting a loss of 4 cents per share in the current period, almost double the 2 cents the street was looking for. Margins are really under pressure because they lowered capacity of factories while customers work through inventories. There are signs that's improving, and they gave a quite bullish full-year PC shipment figure as well. 6% gain, John. I think that's the biggest jump since November. So, this is a real reaction in Intel, but a really tough quarter gone.
A decent gain, and I'm looking forward to the programme a little bit later and that interview you've got with the Intel CEO, Ed Ludlow there, catching up with Mr. Gelsinger a little bit later. Pat Gelsinger in conversation with Ed Ludlow, 11:30 later on this morning. Turning to crude, profits from Exxon, Chevron blowing past estimates and showering investors with cash. Chevron redeeming itself after an ugly Q4, and Exxon reporting its best start to a year on record. Abby has more. Hey, Abby.
Hey, John, and all of this with oil below $80 per barrel for many months. But tell that to these two companies that did beat both top and bottom line estimates. Record profits out of Exxon, as you mentioned, really strengthened the Permian Basin here in the U.S. and off the coast of South America. Now, relative to Chevron, their profit did rise to $6.6 billion. The oil refining profits rebounded amid climbing fuel demand. The stock a little bit soft here, but if you take a look at Exxon, strength for that stock and their net income of $11.4 billion, the best start to a year ever. I think the biggest point, though, is over the last couple of years, John, the S&P 500 down slightly, both of these stocks up huge as they continue to deliver cash, quite literally, to investors in the form of dividends. They didn't raise this quarter, but nonetheless, again, solid performance for these stocks.
Downstream numbers from Chevron, just phenomenal. Abby, thank you for that. Thank you very much. Want to turn to the banks. Really important weekend again, potentially for First Republic. Shares of First Republic rebounding amid reports of a potential rescue plan. The bank telling Reuters, we are engaged in discussions with multiple parties about our strategic options while continuing to serve our clients. That stock, as you know, through Thursday, down 95% this year. Shanali, do we get a solution going into the weekend?
The greatest question of all, John. Remember, we have known that they've been exploring strategic options. They have been in talks with multiple parties for weeks on Wall Street. The difference now is Reuters reporting that the FDIC, Treasury Department, and the Federal Reserve are among government bodies holding talks, orchestrating talks with financial companies for some potential solutions here. Now, when I talk to my sources as well on Wall Street, what the big worry here is any potential sale or even receivership here. It makes those underwater loans come to realization here. Now, the trick here is avoiding those markdowns. Can a deal be reached without putting this bank into receivership? That is certainly the preferred option, both for the industry, the FDIC, as well as the bank. Now, can they avoid that? This is a bank that has dropped 56% this week so far in trading, now getting a lift just a little bit above 1-2% here, just about trading at all week, really, about 7-8% of its book value. This is a bank also, John, there's a lot of questions about whether it limps along as a zombie. A lot of options here for First Republic. For the market, I think people are hoping for a resolution sooner rather than later so that the headlines don't keep bleeding through.
Two things to focus on, that bank, Shonali, and a little bit later we get a report from the Vice Chair of Supervision of the Federal Reserve, Michael Barr. You're going to break that down for us in about 10 minutes from now. Looking forward to that coverage in just a moment. Let's get back to tech. One big move, Snap, on track for its biggest intraday drop in more than 6 months. This after the company reported declining sales amid a major change in its ad tools. The company saying this: we anticipate that it will take time for some of our advertisers to fully recover and for our models to become better tuned to their new objectives. Katie Greifert joins us now. Katie, that stock getting hammered.
Big time. And it's not just Snap. You also have Pinterest down double digits as well. So social media really getting slammed this morning. Let's talk about Snap, though, because currently you look at the shares off by 19%. Of course, it did post its first ever decline in revenue, but it was that advertising picture that seems to be getting shareholders really nervous here. Like you said, John, again, citing continued disruption in demand for advertising from both macro pressures and Snap's own product changes. Snap also warning it's going to take some time for advertisers to fully recover. You can see that disappointment in the shares right now. Let's quickly talk about Pinterest as well, because it's also plunging this morning. First quarter revenue, it actually beat estimates, but the quarter's net loss of $209 million was larger than expected. And as an analyst noted, Pinterest spending is ticking higher at a time when big tech is reining in costs overall. You can see that's hitting shares this morning down almost 14%, John.
Katie, thank you. Snap down almost 20%. Unreal. Thanks for being with us. Let's get to Michael Morton of Moffett-Nathanson on Amazon. Amazon still with an outperform rating. You still got a 118 price target, Michael. Has it gone back to 118 now?
Yes. Good morning, John. Thanks for having me. We have a 118 price target, and we value Amazon on an EBIT multiple, as we think it's the most valuable indicator of what investors are focused on and where we think the stock will trade over the next 12 to 24 months.
Michael, one question you asked this week going into these numbers: are we all too bullish? Michael, I'm going to allow you to answer your own question. Are we all too bullish?
Yeah, it depends what business segment you're talking about. I think there's a lot of upside opportunity, and we are extremely bullish in regards to the retail segment. It's growing through a tough macro environment, getting leverage through the fulfillment business, a lot of opportunity to improve unit economics. For AWS, we're continuing to see the headwinds that we've faced for the last several quarters. The pressure from customer optimization is bleeding into next quarter. We saw that 500 basis point step down. So I think, as the title of our note this morning stated, is the glass half full or is it half empty? We're in an environment where the improvements from retail are being offset by the disappointments in AWS.
Talk to me about AWS and the guide that we got yesterday. Compare the guide to the numbers. 1Q seemed pretty good. The stock was up by more than 10%, up 11, up 12, then rolled over aggressively. What did you make of the guidance they've given for us going into April and beyond, Michael?
Yeah, there was a little bit of confusion in communication that came from the company after fourth quarter when they told you they were exiting the quarter at mid-teens. Investors and Wall Street analysts all thought that meant 15% and progressively worked it down. So then when they put up results from the quarter of 16% growth, there was this initial gut reaction that, oh, wow, they're managing expectations. They kind of sandbagged. This is going to be a lot better than we thought. When then they guided down for the next quarter with a 500 basis point step down, everyone just started scratching their head and realizing Amazon's interpretation of what mid-teens is, what they had told us in the prior quarter, was probably in the 17 to 18% range. They exited the quarter much lower than the 16% reported number would indicate. So this trend just really is working down linearly. That's why you saw those price actions after the results that were so dramatic, because after the investor base was really digesting this swing of emotions and kind of and estimates.
Michael, how does that stack up with what we heard from the likes of Google, the likes of Microsoft?
Yeah, I would say the deceleration trends that the space is facing are relatively similar. Google is growing from a smaller base. It's Amazon's market share has slowly shifted downwards kind of quarter over quarter as Microsoft's Azure and GCP continue to grow. When you effectively start at the beginning at 100% market share, of an industry, there's really only one place to go, and it's to cede a little bit of share. That was a lot of the concern coming into this quarter. There's this narrative around artificial intelligence, and it's a very real thing, but there's a public relations battle that is occurring right now, and whoever's making the most noise could garner the most business. So investors were concerned that you could see a step change in this market share dynamic I was just speaking to, and that didn't really materialize this quarter. And then also in the 10Q that was filed this morning, the backlog for AWS, which is what customers pay ahead of time, had a nice step up at a larger pace than prior quarters. So that helps also alleviate fears around this competitive dynamic. But still, this decreasing demand on the back of optimization, a lot of uncertainty, and it's really hard to underwrite assumptions in the near term.
Michael, just finally on the AI piece, you brought that up. I thought what you said was pretty interesting just then. Are you saying that some of the names that have benefited from this conversation are just doing a better job at talking about it as opposed to positioning their company for it?
Well, I don't want to put everybody in the same basket here, right? The solutions that are offered by Microsoft, offered by Google, and by Amazon are very real. I'm sure at the end of this quarter, we could run a search for the amount of mentions of AI by all companies, and it's going to be this parabolic step change. But what's occurring is some companies, like Microsoft, has made a lot more noise, a lot more press releases and investor days and news publications about their AI solutions than Amazon had initially out of the gate. You saw in the last 2 weeks, AWS has put out several press releases, highlighted the fact that they actually have chips offering solutions focused on AI and large language models, highlighting that they've been in the machine learning space as a product for AWS since 2017 with SageMaker. But if you're a CEO talking to your team saying, like, we need to think about our AI and our LLM strategy, you've been inundated with more headlines from Microsoft than you have from AWS. So that just, the fear is that it puts Microsoft top of mind in the executive suite. And this is just a narrative and PR battle that's currently being fought out in the marketplace. Several years from now, the increased compute requirements that are created from these large language models is going to be a tide that lifts all boats in the public cloud space.
It's a conversation you and I are going to have for a long time. Michael Morden of MoffettNathanson. Thank you, Michael. Good to catch up,
Thank
sir.
you.
Number 3 waiting on the S&P 500, Amazon. Amazon right now is down by more than 4% in the early part of the session, Coming up, the debt limit debate heating up.
What the House did was the action to deal with the debt limit. The Senate's done nothing. The president has ignored this problem.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Canadian Prime Minister Justin Trudeau. That conversation at 1 p.m. Eastern, 6 p.m. in London. This is Bloomberg.
We are coming up on a debt limit here in June or July. That's where the default raises. So what the House did was the action to deal with the debt limit. The Senate's done nothing. The president has ignored this problem. He's actually putting the economy of America in jeopardy by not doing anything.
Speaker McCarthy calling on President Biden and the Senate to embrace his debt ceiling plan. Democrats pushing back.
House Republicans passed a bill that amounts to a little more than a hard right ransom note to the American people. If Republicans want to sell this terrible agenda to the American people, they should make their case in talks about the budget and appropriations, where it belongs, not by using the full faith and credit of the United States as a hostage.
Bloomberg's Anne-Marie joins us right now from Washington. Let's get away from rhetoric, Anne-Marie. Let's talk about policy. What is it about this that makes it a far-right, hard-right ransom note?
Well, there's a lot of things in this bill, Jonathan, that the Democrats are just not for. This is provisions on Medicaid. This is provisions on the fact that they're going to keep spending just basically status quo. And this is concerning for the Democrats because they want to make sure they're able to get make these social programs, especially this discretionary spending. They want to make sure that they're able to keep that and grow that. So this is where the issue is. But, of course, everyone knows that this bill was just a leveraging tool for McCarthy. And to be able to get it through with just Republican support, because Democrats were all voting no across the board on it, he had to make sure that it had enough for everyone in his party. So he's dealing with centrist Republicans as well as the far right, like the Freedom Caucus. Obviously, if there's going to be a compromise, this bill is going to become much softer.
Have you seen any evidence in the last 24 hours that he's gained leverage?
I have not, in the sense that the White House continues to say that they do not want to have spending cuts, what they talk about and view as the budget, alongside the debt ceiling. They want this to be a two-track. What Speaker McCarthy said to me yesterday was that will not happen. There's two things he will not do, he said to President Biden. This was his message. One, he will not raise taxes, and he will not pass a clean debt ceiling bill. So, Jonathan, that basically means, though, that he is open to other negotiation and talks about other items that were in this bill, but those are really his hard lines. But at the same time, the White House is not budging that they want a two-track avenue to go forward. And, of course, the Senate, you heard from Schumer there, he says this is dead on arrival, calling it a ransom note.
Based on the conversations that you and Joe Mathew are having on balance of power in the afternoons, what do people believe will break the impasse?
Well, I think at some point everyone does think that President Biden will have to have a meeting, but maybe it won't be just with Speaker McCarthy. Maybe it will be with top leaders, Speaker McCarthy, Hakeem Jeffries, Senator Schumer, Mitch McConnell. Some are thinking that potentially this can get done in the Senate, and then they'd have to sell it to the House, and they're going to need Democrat votes in the House if they were going to do it. So then that would be Schumer, McConnell, and Biden works very well with the Senate because of all his years there. He was able last year to do a debt ceiling increase with Mitch McConnell. But the issue is at the moment, Mitch McConnell is still deferring to House Speaker Kevin McCarthy to take the lead on these negotiations.
AMH, looking forward to the programme a little bit later, 5 p.m. Eastern Time, with Joe Mathew, breaking down some of these issues. Quick data point for you. Hello, Chicago PMI. 48.6, previous number 43.8, the estimate 43.6, and some market action off the back of it for you. Equities just turning positive on the S&P 500. In the bond market, just about unchanged still on a 2-year at 4.068%, but that's a better data point on the Chicago PMI, 48.6 against an estimate of 43.6. 48.6 versus 43.6. Equities just about turning positive. Attention's going to shift away later this morning. About an hour and 10 minutes from now, the Fed is set to publish a review of its supervision of SVB, or lack thereof. Investors expecting to learn more about what sparked the bank's failure. Shanali Basak, this is going to be a big one a little bit later this morning.
It certainly is, and it's important for a few reasons. John, remember that Fed Vice Chair of Supervision Michael Barr has already acknowledged that the Federal Reserve had lapses in its oversight when it comes to Silicon Valley Bank. This is as presented in a March hearing with the House committee that overviews what is going on at the Fed and its oversight. The reason it matters so much for Wall Street, John, as well, is the big banks are so nervous about getting slapped with more regulation in the wake of these banking crises. And really what they're saying is it's not more rules, it's not more red lines we need when the failure of supervision has been a big issue already. Now remember, this is the Fed's own review that is led by Michael Barr himself. But remember, there are other reviews to look out for as well, including the Inspector General's report that is expected in a 6-month time frame from when they initially announced it about a month ago. So this is not the only way that the Fed is going to be under pressure when it comes to its oversight of Silicon Valley Bank as well as the banking system. But remember, we have also reported, we wonder here, are they going to address the cultural issues and to what extent that caused some of these problems as reported by many of our colleagues here at Bloomberg News? The feel-good culture over at the San Francisco Fed and the bureaucracy that has reportedly led to a lot of this oversight that was targeted more than a year ago for Silicon Valley Bank.
Good weather breeds complacency. You know, Shani, that's what happens on the West Coast. Just,
not here, though.
Just the happy times. Not in New York, no. Everyone's miserable, so they work really hard. Shani, thank you, as always. Coming up, the trading diary. Your equity market just about unchanged on the S&P 500. The Nasdaq a little softer, negative 0.2%. This is Bloomberg. Equities just about positive on the S&P 500. Let's get to the trading diary. The week ahead for you. UMH consumer sentiment at the top of the hour. 11 a.m. the Fed releasing its internal review of SVB's failure. On Wednesday, the Fed decision, followed by Chairman Powell's news conference. The ECB with its own rate decision on Thursday. Apple after the close. And we round out the week with payrolls. I round out the week right now. Thank you for choosing Bloomberg TV. Just a final word. My good friend, my EP, my boss, Jamie Berlin told me that I couldn't say happy birthday yesterday. He said nothing about today. Happy birthday, Jamie, from New York. This is Bloomberg.